Hey guys, in this video, I want to share with you the best growth ETFs for 2026. As you've probably noticed, high growth companies have had an incredible run over the last few years, and there is no sign this is slowing down anytime soon. For example, over the last 20 years, value stocks have returned 286%, while growth stocks have returned 897%. However, not all growth ETFs are the same, and some perform better than others. Every ETF in this video has returned between 15 and 25% just this year, and for each one, I'll be going over how long they've been trading, what they invest in, what their performance looks like, and how they might fit in your portfolio. By the way, if you're new here, my name is Brian. I'm a former investment banker with a Master of Science in Finance, and my goal is to help you grow your net worth and invest with confidence. If you like videos like this where I break down the best investments of a specific type, like the best value ETFs, or in this case, the best growth ETFs, consider subscribing to join a fast-growing community of over 1,000 like-minded investors. In fact, this video exists because someone in the comments asked for it, and if you look at my recent videos, you'll see that I respond to every single comment with detailed, thoughtful responses that you won't find anywhere else on YouTube. Of course, you don't need to be subscribed to leave a comment, but I do plan on making 2026 packed with value, and I don't want you to miss out. So let's get right into it, and the first ETF on this list is the Vanguard Growth ETF, ticker symbol VUG. This ETF started all the way back in January 2004, and it currently trades at $485 per share and has total assets under management of $203 billion. The expense ratio for VUG is just 0.04%, making it one of the cheapest on this list. That means that for every $10,000 you invest in this ETF, you can expect to pay about $4 per year in management fees. In exchange for those fees, you're getting a portfolio that tracks the crisp US Large Cap Index, and there are a few things that make this index unique. The first is that this index defines large cap companies as those with market capitalizations over $26 billion. The second, and arguably more important, is how this index defines growth companies. To do so, they use a combination of both historical and projected factors, including earnings per share and sales growth, as well as return on assets. And while these factors may seem complicated based on these lengthy descriptions, all it boils down to is this index is looking for companies that are growing their financial profile over the previous 1 to 3 years, as well as over the next 1 to 2 years. This results in a portfolio of very big companies that are associated with high growth, such as Nvidia, Apple, Microsoft, Amazon, and Broadcom, just to name a few. And as you might expect, this leads to quite a lopsided portfolio when it comes to sector diversification, with over 62% exposure just to the tech sector alone. When it comes to performance, VUG has a very strong track record, with a total return of 20.04% year to date, and a 12.13 annualized return since its inception all the way back in 2004. To put that into perspective, a $10,000 investment at the start of the year in VUG today would be worth $12,004, and that same $10,000 invested back in 2004 when the fund first started, today would be worth $121,860. If you're considering adding VUG to your portfolio, given that it is a large cap growth ETF, it would pair well with either a value-focused ETF or a small cap ETF, which is the focus of the next one on this list. Next up, we have the Vanguard Russell 2000 Growth ETF, ticker symbol VTWG. This fund started back in September of 2010, and it currently trades at $243 per share with $1.1 billion under management, making it by far the smallest ETF on this list in terms of total assets. The expense ratio for VTWG is a little bit higher than the last ETF at 0.10%. meaning that for every $10,000 invested in this fund, you can expect to pay about $10 per year in management fees. In exchange for those fees, you're getting exposure to a portfolio that tracks the Russell 2000 Growth Index, which is a very different index from the previous ETF we looked at, not just in terms of market cap, but also in the way that this index selects its growth stocks. In terms of size, this ETF holds the 2,000 smallest stocks in the Russell Index, all of which have a market cap larger than $30 million. When it comes to selecting growth stocks, this index relies on just 2 metrics compared to the 6 of the last index. Those 2 metrics being forecasted medium-term growth over the next 2 years and sales per share historical growth over the last 5 years. This results in a very diversified portfolio with no single stock taking more than 2% of the holdings, and big names like Bloom Energy, Credo Technology, IonQ, Fabrinet, and Rigetti Computing. And one of the main features of this ETF is the sector diversification, with the biggest sector being healthcare at 25.6%, followed by industrials at 24%, and then technology at 18.3%. Since its inception, VTWG has had some pretty solid, albeit volatile performance, which is to be expected with small cap stocks, with year-to-date returns of 14.54% and an 11.16% since the fund's inception. To put this into perspective, a $10,000 investment in this fund at the start of the year today would be worth $11,454, and that same investment during the fund's inception in 2010 today would be worth $49,884. If you're thinking about adding VTWG to your portfolio, it is a small cap ETF, so you might want to add it with a large cap ETF like the previous one we just talked about, or the next ETF on this list, which has the highest annual returns of all the funds in this video since its inception in 2009. The third ETF on this list is the Schwab US Large Cap Growth ETF, ticker symbol SCHG. This fund got its start all the way back in December 2009, and it currently trades at $33 per share with total assets under management of $66 billion. SCHG has an expense ratio of just 0.04%, tying it with VUG for the cheapest ETF on this list. This means that for every $10,000 invested in SCHG, you can expect to pay around $4 per year in management fees. In exchange for those fees, you're getting access to a portfolio that tracks the Dow Jones US Large Cap Growth Total Stock Market Index. And while this index is similar to the other large cap index that we looked at earlier, in terms of picking which stocks are considered growth companies, that is where things get pretty different. This index uses 6 different metrics to filter out growth stocks, those being projected price to earnings, projected earnings growth, price to book ratio, trailing dividend yield, trailing revenue growth, and trailing earnings growth. However, I do have one small problem with this methodology. It says here that it has 2 projected, 2 current, and 2 historical measures. But just by looking at these metrics, we can see that there are 2 projected, 1 current, and 3 historical measures. Now, I know it's a little nitpicky and it's probably just a typo. If I had to guess, the trailing dividend yield is actually meant to be current dividend yield, but I just wanted to point that out because nothing gets by us on this channel. What's more important is what ends up in our portfolio at the end of the day. In this case, those being large technology stocks like Nvidia, Apple, Microsoft, Broadcom, and Amazon, just to name a few. And one of the things I like about SCHG is that while there is a heavy exposure to the technology sector, it is not as lopsided as VUG, which had over 60% exposed just to that sector. And this has contributed to some best-in-class performance with year-to-date returns of 18.08%, and a 16.78% annualized return since the fund's inception in 2010. To put that into perspective, a $10,000 investment in SCHG at the beginning of the year today would be worth $11,808, and that same investment made during the fund's inception back in 2009 today would be worth $119,645. Now, if you're thinking about adding SCHG to your portfolio, keep in mind that it is a large cap growth ETF, so you might want to pair it with a small cap ETF like the one we just talked about, or an international ETF, which is the focus of the next one on this list. The fourth ETF on this list is the Pacers Developed Markets Cash Cows Growth Leaders ETF, ticker symbol EAFG. This ETF started much more recently in March of 2024, and while I would normally avoid including any ETFs that don't at least have a 5-year track record, there honestly aren't very many good international growth ETFs. However, there was quite a bit of interest in the comment sections of my previous videos related to international ETFs, so after a lot of research, this is the best international growth ETF that I've found. This fund currently trades at $23 per share and has total assets under management of $2.9 billion. This fund also has a relatively high expense ratio of 0.65%, meaning that for every $10,000 invested in this fund, you can expect to pay about $65 per year in management fees. In exchange for those relatively high fees, you're getting access to a portfolio that tracks the MSCI EAFE index with a focus on companies that are generating free cash flow and have strong price momentum. While this portfolio doesn't explicitly focus on traditional growth metrics like revenue or earnings per share, the management team over at Pacer have identified that higher free cash flow margins over time may produce higher current and future sales and earnings growth, and it's resulted in very strong performance so far. This fund is the strongest year-to-date performer on this list with a return of 24.56% and an annualized return since its inception in March of 2024 of 23.6%. To put that into perspective, a $10,000 investment in EAFG at the beginning of this year today would be worth $12,456, and that same investment during the fund's recent inception of March 2024 today would be worth $12,360. Now, if you're thinking about adding EAFG to your portfolio, keep in mind that it does have a relatively short track record, and because it's an international ETF, it would pair very well with a large cap based ETF like the next one on this list, which has some of the strongest long-term annual returns of everything we've talked about so far. Last but certainly not least, we have the Vanguard Mega Cap Growth ETF, ticker symbol MGK. This fund started all the way back in December 2007, and it currently trades at $410 per share with total assets under management of about $33 billion. Given that this is a Vanguard fund, it also has the second lowest expense ratio on this list at just 0.07%, which means that for every $10,000 invested in MGK, you can expect to pay about $7 per year in management fees. In exchange for those fees, you're getting a portfolio that tracks the CRSP US Mega Cap Growth Index, which is the same index that we used for VUG, the first ETF on this list, with one major difference. That being the size of the companies in this portfolio, with mega cap companies being defined as publicly traded companies with over $84 billion in market capitalization. This results in a very concentrated list of high growth companies like Nvidia at 14% of the portfolio, Apple at 12%, and Microsoft at 11% of this ETF. And as you've probably already realized just from looking at those holdings, we can see that there is a very large exposure to the technology sector at 69%, with the next highest being consumer discretionary at around 16%. This makes MGK arguably the growthiest of the growth ETFs, which has resulted in very strong performance, with year-to-date returns of 21.08% and an annualized return since the fund's inception in December of 2007 of 13.83%. And to put those returns into perspective, a $10,000 investment in MGK at the beginning of this year today would be worth about $12,108. And that same investment during the fund's inception back in 2007 today would be worth $102,334. And if you're thinking about adding MGK to your portfolio, given that it is so heavily tilted towards growth, you may want to pair it with some high-performing value ETFs that I covered in this video, or some high-performing dividend ETFs that I just covered in this video.